But the big meetings are for you tomorrow? Or here we are. I just realized that we start this week with a speaker from the BIS, Andrea Meckler, in the first panel on Wednesday, and we are going to conclude this week, if I may say, at least the part of the Economy Festival. I know there is another event coming up tomorrow. But again, with the BIS, so it's a pleasure to have Hyun Shin, who is the economic advisor at the BIS. And in preparation of this file chat, I was listening to the latest quarterly update from the BIS, something that I encourage you to do because they publish very good research. And actually, they zoom in on some of the topics that we've been debating in the last 2 days. So I take this opportunity, this file chat, to really try to wrap up the whole 3 days that we've been going through. And let me start, first of all, from the state of the global economy, maybe with a little bit of a focus on what's going on in the US, which at the end of the day, as you can see also from the question, is the main topic of discussion that we had today, at least. So let's start from that.
Yeah. Well, the theme of many of the publications coming out from the IMF this time around is, if you like, how much the US is out of sync with the rest of the world in being the engine for growth. I think that's been, one of the remarkable facts among many has been how fast productivity has been increasing. And that's not the case in the rest of the world. It's very much something that you see in the US. It seems like something that's born out of a greater elasticity of supply. I think the supply side of the economy is a very big theme of the last few months. And there's also a hint of something that we last saw in the 1990s. I mean, there was a quip that Bob Solow had many years ago in the 1990s about, we see computers everywhere, but except for in the productivity statistics. But he was speaking just before productivity in the US really took off in the 1990s. And I wonder whether there's some element of that as well. So on the one hand, it's supply, in particular the labor market. There's a sort of theme about increased immigration also really powering the labor market. But also there is this potential productivity increase. And an interesting question is why? Now, some commentators have pointed to, if you like, the benefits of running the economy hot. So if you run the economy hot, productivity sort of increases endogenously. So that's one argument. We'll need to see, whether that has legs eventually. Having said all of this, as you well know, and as you've been hearing in all the events this week, there is a doubt about the durability of the disinflation. And let me say a couple of words, actually, now that Max has mentioned the quarterly review, let me mention a couple of things that we put out in the quarterly review in March. There's a piece on services inflation, which I would highly recommend that you take a look at. So what we said in that piece is, if you look at the longer period, there is actually a remarkable relationship between the price level of services and the price level of goods. So if you look across economies, a very, very well-established pattern is that the price of services rise faster than the price of goods. So that if you look at the ratio of the price of services to the price of goods, there is an unmistakable upward trend. And it's a remarkable, very, very stable kind of relationship. And there are lots of reasons for this. I mean, two very important ones are services have a higher income elasticity. So as economies grow, there is a greater tendency to buy more services. And so there is if you like, this upward trend in services relative to goods. So there is a disinflation in goods relative to services. So that's a very well-established trend. The other one is more of a productivity story, that the labor-intensive sectors tend to have a lower productivity growth. And that also means that wages, impact much more the services sector. And that also gives rise to this upward trending line. Now, during the pandemic, this relationship broke down. And it was completely, the relationship completely broke down, and we know the story about supply chains and the whiplash effect, and the whole story of how goods price inflation really sort of shot higher relative to services. So what we say in this piece is, well, what would happen if the previously well-established relations reasserted itself? Now, there's no reason why it should reassert itself, other than the fact that it's a very, very long-running pattern. But suppose it did reassert itself. How would it manifest itself? Well, it would manifest itself in the form of higher services inflation. And to the extent that we are going back to this very well-established pattern, services inflation, sticky services inflation is exactly what you would expect. So I think time will tell whether this is indeed that previous relationship reasserting itself. Sticky inflation has lots of implications. So one implication, of course, is that R star may be higher. And I think we get a sense of that because policy rates are now very high relative to recent history, but the economy is doing remarkably well. So that's a very superficial sense of R star being higher. But irrespective of R star, what should longer rates do? So rather than worrying about the short-term policy rate, what about, let's say, the 10-year yield? Where should that be in this kind of environment? Well, here I would sort of mention two other factors. One is fiscal, which you also mentioned and the previous panel covered in detail. The second, of course, is the breakdown of the bond equity correlation. So the flipping of the sign of the bond equity correlation. Now, if you go back long enough, bonds and equities, the returns were positively correlated. So, when stocks were doing well, that's when also the bonds were doing well. And that positive correlation came about because the main macro risk was inflation. And inflation is bad for both. But that period lasted only until about 2000. Between 2000 until the pandemic, we had this long period where we got used to a negative correlation. And this was a period which you all remember, where bonds did well when stocks did badly. There was a safety, there was a safe haven effect. And that was because the main macro risk was not inflation, it was actually deflation. And so in a deflationary environment, bonds did very well. And so bonds became a very good natural hedge to a stock portfolio. And hence the 60-40 portfolio, this became like a standard. And then you could put some flourishes on that with various other strategies that are built on top of that. After COVID, we're now back to the previous correlation. So it's flipped now, and it's become positive. So bonds and equities are now positively correlated. Quite naturally, because the main risk is, again, inflation. So even if inflation comes down, the risk of inflation coming back up means that the correlation is now positive. So what does that imply? It means that the hedging premium that used to be in bonds are no longer there. And we see that in the increase in real yields. So remember, previously, before COVID, real yields were either zero or negative. Now real yields, as in tips, we see now considerably positive. And to that extent, I think, irrespective of R star, I think we can argue that there is something that's going to, we'll need to watch very closely what these longer term rates will be. And if we are in the new regime, then there are some pretty big consequences. So for one, if the yield curve then, reverses the inversion, so if it actually becomes uninverted again, then I think the risk premium that's going to be in that yield means that, with a pretty high policy rate, if it's going to be steeper, then there are pretty big consequences. The other aspect,
Which will be the norm.
which will be the norm. The other aspect, of course, is the dollar. And as Rashad said, this is a very, very big theme. And a stronger dollar is not simply a kind of trade, adjusting market price. I think much more important for many of the countries around the table is the risk-taking channel of exchange rates. And a stronger dollar, as we've seen this week, in Asia in particular, there is a risk-taking channel effect of a stronger dollar as well. Now, one thing to watch out for is, will we have a repeat of what we saw in 2022? So remember what we had in 2022. We had a huge increase in commodity prices. That's the Russian invasion of Ukraine. That coincided with a stronger dollar as the Fed was hiking very rapidly. And remember what happened to inflation. Inflation shot up in the euro area, in the UK, in Japan, relative to where it was. But even in Japan, inflation rose, in Korea, because you had this double whammy effect where commodities are priced in dollars, but dollar rose and commodity prices rose in terms of dollars, which meant that if you're importing commodities in the euro area, in the UK, this is a very, very big push in import costs. And there's something really very interesting going on. Again, so there's another correlation we have to bear in mind. It used to be the case that commodities and the dollar were negatively correlated. That's a rule of thumb that Rashad and many other policymakers have come to rely on. When the dollar is strong, commodity prices fall. But in 22, they went up together. And we're seeing it again. And there's a very, very interesting question out there. Is this now the new norm? So is it the new norm that when the dollar strengthens, we also have commodity prices going up? Or rather, when commodity prices go up, will we also see a stronger dollar? And there's a very interesting piece, again, from the BIS that we put out some time ago. You may know that the US is now a net energy exporter. So that's always been the case for natural gas. And marginally speaking, the US has also become an oil exporter as well. And if that's something that is going to be a different backdrop, then again, the dollar and financial conditions is going to be a very important aspect. So overall, good news. The US has been doing fantastically well, but there's the fiscal, and then there are these uncertainties on.
I'm an asset allocator, so we look at the negative correlation very closely, and the 10-year actually.
Absolutely.
When we look at asset allocation, for us, the policy rate might be very important for markets short term, but for an asset allocator, in reality, what really matters is the 10-year, which, by the way, remain pretty low if you think about what happened. That might explain also why equity price remain relatively high despite all the events that we had. So this actually is perfect because it leads me to the second part of our conversation, which is about the financial stability. And I think I was actually in a very interesting event organized by the BIS about alternative asset classes. We heard today also from the IMF, based on the latest report, that if you go and search for real big source of risk, at the moment, actually, you don't find them. Or at least they're not so prominent and so visible. But based on your conversation, it seems to me that probably a potential source of risk is these rising long-term interest rates, which we might start to see, particularly if the situation of persisting high inflation or higher than target remain in place. Do you agree on the reading? And what is your view as a central bank or the central banks in terms of risk out there?
I think in general, I think you're right that the usual kind of suspects have not really been very prominent. And I think one of the reasons for that is that we didn't come into this hiking cycle with a huge credit boom. So, whenever you've had a huge credit boom and then, financial conditions tighten, that's when all the problems sort of materialize. So we haven't had that, at least not in private sector debt. Let's say just before the GFC, or indeed the crises of the 1990s. That's when, the credit boom was really a very, very important backdrop. But you're absolutely right that I think this time around, one of the things that is certainly worth watching is fiscal, and in particular the stock of sovereign debt outstanding. In particular, if it can actually lead to some amplification effects. So you know very well that in the bond market, there are various sort of amplification channels that kick in when the yield curve is steepening. So we see that, for example. So it could be, for example, let me give you a few textbook examples. So one example might be what happened in the US in the 1990s, in particular the 1994 episode when the Fed raised rates very rapidly, but then the long rate rose as much as the short-term rate. And one of the stories behind that was the so-called negative convexity mortgage hedging story. So, if you're trying to hedge your mortgage bond portfolio by either using swaps or the treasury market, because of the fact that there's an early repayment option for U.S. mortgages, certainly in the U.S., there's a tendency that when rates rise, typically you would see duration go up, actually go down. But if there's a repayment, or if there's a lack of repayment, then actually the duration can extend rather than come down. And that can set in motion some of these amplification effects. Another story, and there was a hint of this during the gilt episode 2 years ago, is also to do with hedging, but from duration matching investors like life insurance companies and some pension funds, where duration liabilities tend to be longer than asset liabilities. Duration is much longer for the liability side of the balance sheet than the assets that are out there. So when rates rise, of course, the duration comes in on both sides of the balance sheet. But because of the convexity, liability duration is coming in much faster. And so what you find is that you've got too much duration on the asset side. So you have to sell in order to rebalance. So what's just happened? Rates have risen and you're selling fixed income. But if you sell, what happens to rates?
There's more.
And then you can get into a potential feedback loop. And the LDI story had a bit of there was much more going on there because of the leverage, but there was also a hint of this. And again, that's another amplification channel. So there are these various amplification channels that could be lying in wait.
And the liquidity factor as well could come into.
And the amplification channels will mean that whenever you have a uninverting of the yield curve or a steepening of the yield curve, you're almost certainly going to have to overshoot. You'll almost certainly overshoot before you actually settle down. So there are these various scenarios that we have to worry about. And if it's in combination with various events in the FX market, and in particular, the risk-taking channel that Rashad described in the previous panel, that's certainly going to be really, pouring more fuel.
Where do you see more the risk from a public debt sustainability perspective? The focus is on the US, I guess, also because of the election, so there are different. But where do you see in the advanced economies problem of public debt will eventually become more visible or sooner than in other parts?
Well, I'm not going to mention,
always US.
yeah, I'm not going to mention names, but clearly the US is special because, you know, it has the dollar, and in no other country has the dollar. And, you know, there is a lot more appetite for the dollar. But there's a point that's worth bearing in mind. We talk a lot about the impact of fiscal policy on monetary policy. So Russia talked about this earlier. But it's worth thinking also about the reverse causation.
Yeah.
What is the impact of monetary policy on fiscal policy? And I think there is no doubt that the long period of low for long has meant that monetary policy has been hugely influential in fiscal policy, in that when rates are low, it's very tempting to try and exploit that. You know, we have arguments about R minus G being negative. If R minus G is negative, why not take advantage of that and expand, you know, fiscal policy? It's not just the quantity as well. It's also the duration. So in the period of low for long, before the pandemic, we had a huge terming out of debt of all kinds, but in particular the sovereign market. Now that's not universal. I think for some countries they haven't seen this terming out, but for a few advanced economies and for most emerging economies, there's been a huge terming out of sovereign debt. So if you combine the quantity,
because the demand was strong from investors to get a return.
I mean, you know, what is there not to like?
Yeah.
If you can place 10-year bonds at historically very low rates.
So there is a delay effect in terms of.
So I think so. This is the key message that I want to just put on the table, and we could debate this. It's not simply the debt notional amounts; it's also the duration. So you have a double whammy effect. So in terms of the effective duration, the aggregate duration, that's gone up hugely because of this combination of more expansive fiscal policy and the way that it was financed. There's been this huge terming out. And what we've seen actually, as rates have gone up, is a very painful reversal of both of these trends. So not only is the quantity of issuance down, well, it's not as, you know, increasing as rapidly as before. And the R minus G argument seems to have really retreated, but the duration is also coming down. And in some of the advanced economies, you know, I mean, let me mention the UK because that's a very, very important case. The UK is one of these cases where they had a very deliberate policy of terming out in order to, you know, to have a more stable funding source. Of course, this has also meant that you know, the Bank of England is one of the few central banks that is also engaging actively in QT, you know, even as they're allowing the balance sheet to shrink. And that means that, you know, we saw during the gilt episode that you know, this very long duration.
And also there's a demand side investor currently are very positioned short duration because of course that's the place to be. So the demand for long duration is largely from liability matching.
Liability matching, but also I think
that could dry up pretty
but actually, let me ask
you,
you, since you're in the market, and this is actually a fireside chat, so I'm allowed to ask you questions.
Thank you.
So,
if I can answer, I hope so.
So still the curve is inverted.
Yeah.
How long would it take for investors to be shaken out of the idea that the curve will go back to a previous pre-COVID?
It depends on how it inverts. If it will invert because policy rates come down in, let's say, a controlled way, if I can use the term, which basically means investors will start to move away from short duration and money market funds and will feel more comfortable to move on long-term bonds because they feel that inflation is under control and the inflation risk on the long part of the curve is lower, and then they will start adding duration. At the moment, I see something like more a barbell. So if you're an investor and you look at the world and you say, okay, softish landing in my baseline scenario, I continue to stay in short duration money markets because that's where in risk adjusted term, it's difficult to beat it. But I add some duration because if eventually a recession kicks in,
it's the option
I
value.
will get an edge. Because one of the problems of the positive correlation is that you don't have diversification benefits. Before the diversification were there, you just have to grab them depending where you are in the risk return profile. The other aspect that could also in some way fit your narrative is gold. Maybe gold is rising because in the lack of diversification, gold can be an edge that or a diversifier. Even if gold has a lot of characteristics which don't make it a very good diversifier, but given the lack of diversification, gold is rising. And why is rising? Actually, gold should not rise according to the only thing we know is the inverse relationship with real rates. This is broken. So many of the things that you say also fits the narrative around gold and rising so strongly. Geopolitics is another one, but I believe more in the hedging element.
In the hedging element.
I believe. Geopolitics, I don't think in the end gold is such an incredible hedge. I mean, I'm just looking at the watch. We will see market that is telling me yes. Maybe I want to. We started these 2 days with digital CDBC, and which I understand that maybe is a less, let's say, exciting topic.
Well, it's very exciting.
It doesn't move markets.
It's very exciting.
But we definitely believe that it could be a game changer. So I know that the BS, we heard from many from the BS how you are involved. So Project Agora, we were talking about this, is for you is something really, really important. Can you just
it's a very
let's
important
end on
project.
this topic and what does it mean for the future of
so
the
let me
global
say a few
financial
words
system?
on Project Agora, and Usman is here, so he can also back me up. In a word, it's a tokenized deposit platform, and we will have tokenized deposits and central bank money on a programmable platform. So that's a one-sentence description. But let me just explain. Let me just unpack that and say why this is such a big deal. Now, when I send someone a payment using a stable coin, the recipient acquires a claim on the issuer of that stable coin. The recipient has no choice, right? Because the stable coin is sent, and this, so you're acquiring a claim on a new issuer. That's very different from the way that we send and receive money today using a bank account. Because when I send money to someone, that someone, the recipient doesn't acquire a claim on my bank. Instead, it's the recipient's bank that just credits the account, and my account is debited. And this happens, this is the way that we send money back and forth because the payment is settled on the central bank's balance sheet. And so when we have tokenized deposits, we don't wake up one morning and say, oh, let me look at my wallet. Well, I've got 10 red dollars, 10 blue dollars, 10 orange dollars. I just have $30. That's it. I mean, that's what the bank account actually. So it actually has what we call the singleness of money. And we talked about this last year in our long chapter on tokenization. And what we wanted to do was to launch a platform where we preserve the same architecture, the singleness of money, and have tokenized deposits as the main means of payment. And because we need settlement, we need central banks there as well. So we have central bank money, we have tokenized deposits, and who do we have? Well, we have central banks that issue the largest international currencies. So that's the dollar, euro, sterling, yen, and Swiss franc, as well as Mexico and Korea. So we have 7 central banks. And then we're just about to go out with a call for expressions of interest to join to the private sector. So this is going to be a joint project with the private sector. And there'll be a handful of banks from each of the jurisdictions. So we're talking about 24 plus private sector institutions who will join. The one condition is that they have access to the central bank. So primarily they will be commercial banks, but if in some jurisdiction a non-bank has access to the central bank's balance sheet, we will have a non-bank PSB as well. And this call for expression is being organized by the IIF.
What is the timeline of this project?
The timeline is that we will have all the parties together within the next few weeks. And then we have this organizing committee that will pursue the project. So it's going to be the BIS on the central banking side and the IIF on the private side who will coordinate the responses. We first need to think very hard about the technology. We do have some preliminary thoughts, but you can imagine this will have to be a platform where we have a distinction between central banks, who are who actually allow the settlement, and the commercial banks who are doing the customer-facing work. So it's not going to be one of the standard off-the-shelf platforms. We'll need to think very hard about this. But by the end of next year, we certainly hope to have the blueprint. And from then on, well, of course, development takes a long time. But the reason why we were very excited about this is that this is not simply a shiny project that's that grabs some headlines. We actually think this is going to be a major innovation, which will unblock some of the real pain points. So what's the biggest pain point currently out there? Well, it's compliance and KYC. And this is what's really been holding back cross-border payments. And if you have tokenization, we can dispense with the separation of messaging and settlement. We can have it all in one go. We can actually have the chain of trust all the way through the payment tracked, just as we track the provenance of any particular token. And we can overcome a lot of the difficulties that is holding back cross-border payments. So this is actually going to be, if you like, perfecting intermediation. So this is our slogan. Agora will perfect intermediation. And what that will do is to provide the circulation system for the global economy that will really back up the real activities of the trading system.
So next year is not going to be CBDC, but tokenization is a topic for the next year. I don't know if we have no time for question, or if there is any question for our last speaker of the day, please do so. Two questions, and then I think.
If you can, so one of the things that seems to be happening is that there is, for the US dollar, there is significant kind of questions about the sustainability of the fiscal situation. And given that the US dollar and the US Treasury market are sort of considered to be the risk-free asset, when you start to introduce risk into the risk-free asset, that starts to potentially have lots of knock-on effects. How do you think about this issue, and what would be your sort of expected path going forward?
Well, I think the standard kind of rules of thumb don't really apply, to the US dollar, because it is the premier, international currency, and we we tend to speculate about the limits of that appetite, but there's always additional room. And so I think this is one area where clearly we cannot abuse that market trust. And I think some of the discussions that have come out from the MMT school, I think, has been somewhat unhelpful in this regard. But I don't think we're anywhere near the limits of that, and we see that in the dollar. So we may be having this conversation several years ahead, but then ask the same question. So I think we're still well away from.
How do you think about that?
Well, you have to think about. Well, let me turn the question this way. So what could an emerging market get away with in terms of MMT? So if you issue, so if you have a very expansive fiscal position, you can either issue debt or you can print money, but typically you would issue debt. But then the question is, who is going to buy your debt? If there's not enough international investors, then the domestic banking system is going to have to hold some of that. And the question is how much, what is the portfolio choice problem between holding domestic currency and an international currency? And the larger the balance sheet of your domestic currency and the bigger the supply, the more attractive it's going to be to hold the international currency instead. And so in all of these historical cases of excessive fiscal, having too expansionary fiscal position, it's always been the exchange rate that gives way. And when your exchange rate gives way, that's a sign that your currency is not worth as much in the eyes of the investors as the dollar. And the question for the dollar is, what is the alternative? So what in that portfolio choice, what is the alternative? And so until that arrives, it's going to be a very uneven playing field. I mean, even for advanced economies, if you're a small, open, advanced economy, it's not emerging advanced distinction that's important. It's whether in that portfolio choice between domestic currency and the dollar, there's going to be enough demand for your domestic currency. And if you're a small, open, advanced economy, you're a small boat in a very stormy sea. And it's not simply about emerging markets. It's also something that has to be borne in mind by advanced economies.
Also, many countries are pegged to the dollar in a hard way. I mean, don't forget the whole Gulf is still pegged 1-to-1. Hong Kong, China, they say it's a basket, but look at the dollar exchange rate. So that's also something which matters. So politics, if they change that, maybe we should start thinking in different terms. But so far.
So the short answer is look at the exchange rate. And exchange rate against whom? Yeah. How about against gold? Maybe crypto stable coins at some point, but it's not big enough. It's not big enough yet.
I think there was another question from the lady, and then I guess we have to close, right?
Yes. Thank you so much for all the tremendous insights. So that gives me a small confidence to ask my question, and that is an issue that has not been discussed anywhere else, and I can't think of a better person to ask this. How concerned are you about central bank losses? Central bank need to recapitalize or not? Which school are you in? What is your insight?
Well, I think central bank losses fall into the same sort of category of answers that I just gave about the exchange rate. So why do we care about central bank losses? Because central banks are not like a private institution. They don't have to repay the liabilities because liabilities are basically fiat money. And what would you repay it with? Well, you would repay it with fiat money. So essentially, there is no redemption pressure. Now, does that mean that there's no constraint? Of course not. So, in fact, it's not really the losses as such. It's more, what are you doing with your fiat money side of the liabilities? Are you financing fiscal spending with no limit and your money supply is increasing? Well, then that portfolio choice that I mentioned is going to tip to one side or the other. And if you engage in monetary financing, it's the clearest case. But even if you issue debt, if you have it through, if you have it through the banking system, and then the central bank has to buy it back, well, it's effectively, you're trying to do QE, and you're creating money, and it's the exchange rate again. So again, the answer is, it's the exchange rate. What's your exchange rate going to do? Now, the one case where the losses do matter for this is when you have a lot of illiquid assets on the asset side of the balance sheet. So we wrote about the Bank of Amsterdam. So it's one of the early proto-central banks that was set up in the 1600s. And there they were actually lending a lot to the Dutch East India Company. And what that meant was, when the exchange rate was under pressure. So the exchange rate in those days was Amsterdam bank guilders versus gold, or the Amsterdam, the guilder in metal coin. So the portfolio choice was between, do I hold a book entry in the Bank of Amsterdam, or do I hold some metal coins? And you need to think about the exchange rate. They were managing the agio, which is the exchange rate between the two. When they needed to shrink the balance sheet, they couldn't, because they had huge losses. And in any case, they had some illiquid loans on the asset side.
There is also fiscal angle.
There is also a fiscal
countries
angle.
where there is like Switzerland, for instance.
There's a fiscal angle
There's
as
a big
well.
fiscal transfer
In
from
fact,
central
they were
banks to the
actually-
canton, and of course, in the
they
last
were
2 years,
actually-
they
yeah.
had losses. They could not
And
transfer the same
the city of Amsterdam was using it like a cookie jar.
Exactly.
And that's when the exchange rate went. And so losses can matter, but much more than losses would be, what are you doing with the money supply?
Maybe it's a reputational as well. They don't like to show losses in the end, like any institution, I would say, overall.
I think there is certainly a political economy dimension. So at some point you will need to recapitalize. There are some countries like Sweden, which is actually, it's in the law that if your equity goes below a certain level, you have to go to parliament and get recapitalized.
I guess the problem is explained to the treasury, because they were used to receive a transfer when there was the QE and stuff like that, and now
And it's
instead
different.
the
It's different.
situation.
It's different.
I guess we are running out of time. So, Mark, I don't know if you want to say something about tomorrow, but first of all, thank you very much. It was very interesting. Thank you.
Very good. Very good.
Thank you.
It's a pleasure. It's always a pleasure.
Listen to you.
Yeah.